Good morning, everyone. This is Daily Trading Analysis with a quick market update for this week in a special weekend video. I would like to share with you yesterday's news and do a quickly recap of what we got this week, in regards of fundamental data. So Friday, we got consumer sentiment preliminary. We got 64, almost 4 more points than the consensus. And inflation expectations are making a new low with 3.3%, and the previous one was 4.2%. The expectations for inflation coming down are getting stronger. The 5-year inflation is ticking 0.1 lower, 3.0%, and overall, we got really good sentiment regarding the consumer. But the thing was with this Fed Waller speech that came a little bit more hawkish than markets were expecting. Even though the consumer sentiment ticked up to 4-month high, as inflation expectations, as I was mentioning, came way lower. The first Fed official to speak, Fed Waller, is a member of the FOMC. He got a really hawkish tone, reiterating the fact that core inflation has not come down fast enough and further tightening may be necessary. So that means the same as the dot plot that we got on FOMC projections, economic projections. Remember that Feds are projecting 2 more rate hikes, and markets are not buying that. We are going to see that a little bit later on the charts. But first, let's do a quick recap of the most important things this week. CPI came lower, general, but the core inflation month-over-month is not progressing. This is what Fed is referring to. The next day, PPI came in the negative. That means good news for inflation coming down from the producer side. But the core PPI still month-over-month flat, still increasing at the same rate. So no progress either on the PPI. We got the economic projections being quite hawkish from the Fed, not raising rates, but saying that 2 more rate hikes are most probably this year and no cuts. This is against what markets is pricing in. Remember that. They are fighting the Feds. Markets are not buying what Fed said. Retail sales came way stronger than expected, and that's, I think, not expected. And last, on Friday, we got huge consumer sentiment. So overall, I think fundamentals this week are not as good as people may think, and it's not the end of the world. I think we need more data. We need strong data that confirms that labor market is cooling down. That is the focus right now. So this week, even though it's not the best week regarding fundamentals, we still need to see incoming data in the coming weeks. So before taking any big conclusions and saying that the bear market is here and we are going to fall off a cliff, let's just go into the charts and analyze the current structure. On the weekly chart, this is the NQ continuous chart. This is a weekly chart. Look at this week. This week is plus 3.61, and it's 1, 2, 3, 4, 5 straight weeks in the green since we broke out from this consolidation down here into this pivot breakout. So Nasdaq is looking stronger, and we are just at this huge resistance, 50,268 from February last year. So this was a nice move, don't get me wrong, but I think we are due for a pullback. And this is a good spot to just wait for that pullback to occur and just wait several levels that might be important to just build a higher low on the weekly. That's good news, but we cannot just expect to continue higher indefinitely. We have to pull back to give the opportunity to players that are on the sidelines to enter the market. So if we check a nice Fibonacci retracement since the moment we broke out, I think we might see, let me just adjust this. So the fib retracement, since the moment we broke out at this candle, so this push on the weekly, this level at more or less 14,100 would be above this pivot and would make sense to build a higher low at these levels. That's the 61.8 fib retracement, and I think a lot of people will be watching either this level from this pivot on these two weeklies, hammer weeklies that we got with bottoming tails around 14,382 or something like that, or 400, or a little bit lower. It will depend, but I'm for sure expecting the markets to pull back and a lot of people to watch that pullback to build higher low into the weekly and also into the daily, because the daily, it's also building a big case for fib retracement 61.8 around 14,100. We might see a pullback around this level. As you can see, triple bottom around 14,248. That's the weekly double bottom that we got with bottoming tails, and then we have this gap. Be aware of these kind of gaps because they are critical for a healthy move. We need the markets to fill these gaps and then make a pullback, consolidate for a second leg or another leg up to really repair these holes, these gaps, and let those people that are on the sidelines to really enter the market and build some bids. So we have this consolidation down here that might be possible around 14,600. I will be watching a higher low build around here. If we enter again this consolidation and we pull back 14,248, we might see something. Let me build the ABCD. I don't want the market to do this because that would basically confirm a lower high, a lower low, and change of trend. Don't get me wrong, we can have several options, a bullish case and a bearish case, but all depends on the kind of pullback that we will be watching in the upcoming weeks, in the coming days, also to fill these gaps and for all those players that are not in the market to really enter that. It's quite important to really see this kind of structure to be built, and we have to be patient because right now we can have perfectly a pullback and it would not be the end of the world. That's for the NQ. For the ES is just skyrocketing, and look at this. This is again the weekly with 2 plus 2.41 in the week. The S&Ps have a little bit more range until critical. We close right here. We have still almost 1.92% until this structure that we got on April last year, around 4,538. We have still room for improvement until this critical resistance, but the NQ, it's already a resistance. So obviously ES is more important. We have to really see the price action on the ES to really extrapolate for the NQ. But if ES starts building legs until here and then it pulls back like this, we might see a false breakout again on the NQ, and you don't want to be that guy that buys the top on the NQ for a good pullback, because that pullback might see like 500 points, things like that, because the volatility and the range of these candles on the weekly NQ is quite high. So be aware of this kind of push into resistance and then do the pullback on the ES, because that might impact a lot of the price action on the NQ that is already in resistance. And for the daily, well, we broke this huge 41.75. We built consolidation as we were doing also on the NQ. And if we check the fib retracement since the breakout, we can see that it aligns more or less in a good way for a nice retest of 43.27 for the second higher low. That would be around here. That would be nice to really continue build the trend after this consolidation breakout. And I think that's really possible, even though fundamentals, we are not quite good this week. We still have room for improvement on the inflation cooling down, and there's a lot of mixed sentiment on the market. I think the trend is quite clear in both NQ and ES. We just have to be patient to build structure and just to mitigate the risk to continue higher on the trend. That would be my case, and that's what I will be watching. Regarding the dollar, well, dollar couldn't push higher. I was expecting basically this kind of move, and if we were to have this kind of move, stock market would basically fall off. So this is aligned with the fact that NQ and ES are getting a lot of strong beats. So dollar is pulling back, but be really careful with this because we already broke this. We broke this range. This was a nice accumulation breakout, and I don't think bulls, longs that were built at these levels, I think those are going to commit again at these levels. So be careful, because if dollar then again gets some beats and retests this level of 103.5, we might see a heavier pullback on the overall markets. So you have to really pay attention to the other different markets that are divergent with the overall market, because if dollar starts getting again strength and it retests these levels or even pushes, because that would be basically a higher low out of this range. So if dollar holds these levels, we might see a heavier pullback than expected on the overall markets. Dollar is contrarian to the overall market, so if dollar pushes up, the NQ and the ES will feel some pain. The same with gold. Gold is not, I was expecting way more from gold, given the fact that the dollar is quite weak. We got like a lot of downside, 1.26 on the dollar, and on the gold we just saw this bottoming candle on the daily. I mean, this is quite good. Look at this range. It got super bought up. If we check the 1 minute chart, not this day, on the Thursday, look at this move. This was something of support, really interesting. So you have to really pay attention to that. On Friday, we just consolidated up here, just holding the point of control. So value is still there. And I expect gold to really, it broke down this range. We were expecting maybe continuation to the downside, but it got rejected. And I think with a lot of shorts trapped down here, we might see the real move now breaking to the upside towards at least 2000. That's a critical level. And then towards the next level of resistance, 2058. If gold does that, then dollar will feel a lot of pain. It will get weaken, and we might see a nice push also on the overall market. So pay a lot of attention to these markets, and that coupled with the fact that yields are still going higher, this is not good actually. This is the kind of thing that you want to stop pushing higher, because the 2-year yield and the 10-year yield going higher and looking still quite bullish after this breakout of consolidation in both the 2-year and the 10-year. That means that they are expecting yields to continue higher, so interest rates to continue higher. Markets are pricing in one more rate hike. Let's check that right now, because in terms of probability from the FedWatch tool, 74% are expecting a new 25 basis points hike, and that would be the last one. If we check the probabilities month over month, you can see that markets analysts are pricing in one more rate hike towards 525, 550, and then starting January 2024, starting cutting rates like pretty aggressively. I don't think this is the case. They might have it right with the fact that only 125 basis points hike due to this year. But we have to really pay attention because the Fed projections have 2 more rate hikes. Markets and analysts are saying 1 more rate hike, so they are going not full commit with the Fed. They are pricing in only one, but they were also pricing in a couple of months ago. They were pricing in aggressive rate cuts this year, and that didn't happen. So they are not perfect. They can get it wrong. So be careful with expectations and just take week after week, day after day, analyzing the fundamentals and also the technical analysis, because several markets can provide you with a lot of information, and that might be your edge to trade these markets. But as I was saying, these 525, 550, it's quite priced in, and let's see what happens, because if yields continue going higher, and as you can see, high yield corporate bonds are not pushing higher, this is risk on yields. Junk yields, basically, they moved higher when risk appetite is really high. And as you can see, they were red. They are not breaking out. I would like to see the high yield corporate bonds like here to really see risk on appetite. But that doesn't, it's not happening. So markets, at least on the bonds market, are pricing in higher interest rates than the stock market. And the stock market is again going ahead of themselves. And that might be an issue in the short term, because if expectations are not met, the stock market might really see a lot of weakness. I'm not going to cover all the stocks. I'm just going to say that Tesla is still being super pushed. The gamma squeeze is really, really big. And I've seen a lot of calls towards 300 that might be massive. And if Tesla continues this way, I mean, it might push the market, the Nasdaq at least, because Apple rejected a new all-time highs, and Microsoft also rejected with this huge candle minus 1.66 on the day, the all-time highs. So these two affected the market in a negative way for sure on Friday. Amazon and Google were also in the red, so we saw red across the board, but Tesla is still there, gamma squeezing like anything else. So pay attention, because perhaps you don't want to trade the Nasdaq into longs, but Tesla might still provide good opportunities for continuing higher with the zero DTE gamblers that it's getting. So finally, look at this. Look at all these banks. KRE was minus 1.37. It's just consolidating here, chopping around. It's not as good as you may think. Financials is minus 0.21. We got a nice break of this level, of this pivot at 33.53, but I was expecting way more continuation. Look at to the left. Look at this huge candle. This was the SVB failure, and we are trying to really repair this. And I'm going to watch this range, because this range is quite critical. If financials continue pushing higher, that might give some legs to the overall market. If it rejected and enters again this range, I mean, financials are quite important. It's one of those sectors that you want to get on your back in order for a bull run to continue higher. Discretionary was a little bit negative, but I mean, this is still looking bullish. It's just rejecting this level up here. And it already provided good opportunity with Tesla's and Amazon pushing. Technology, look at this. Well, you know the deal, right? Technology super, super strong. But let's check this sector funds performance with the tool that we usually do for the 3 days and the 5-day performance, because we are going to see more clearly the kind of performance. This is the 5-day performance on the sectors. Technology up here plus 4%, consumer discretionary, industrials, and financials, and all the defensives are down here, still in the positive, but they are at the bottom. Energy has its own deal with the war and Russia and Saudi Arabia trying to manipulate the market, so they felt the pain. But we have a strong trend into risk on, into rotation into technology in the 5-day. If we go to the, let me check, it's this How can I turn this to the 1 month? Uh, 1 month. This is 1 month. As you can see, again, staples, utilities, healthcare are at the bottom of the barrel. Staples minus 3% and technology plus 13, almost 14%. And year to date, look at this. This is the year of technology. This is the year of technology. So you can really see that risk appetite is really strong in this market. If you are saying, if you are trying to short this market, you are putting yourself at a higher risk than following the trend. I was trying to be a bear in this market, but right now, I think if pullbacks are still met by demand, as I was playing on the weekly and the daily charts on the Nasdaq and the S&Ps, I mean, I will trade those charts. Fundamentally, I think there's a lot of reasons for a bigger pullback, and until we don't see rotation into these sector funds, into defensives, I don't see a reason to really aggressively short the market unless you're a big hedge fund and things like that. Also, going on options, in the last couple of weeks, 0DTE calls have been really strong. So if you want to short the market, you don't even have the possibility of doing it with options because you are going to be destroyed. So basically, if you want to be a bear in this market, you really need to pay attention to the sector rotation. And right now, there's not a sign, at least in my opinion, to really try to see short setups. I prefer the kind of long setups that I explained earlier, but I mean, you have to really be patient right now because these kind of moves, if you see Nvidia, I mean, Nvidia is challenging again new all-time highs and 460, 470, who knows, 500. I mean, technology is really strong. You already saw the performance year to date, month over month, 5 days. There's no clear signs of weakness yet. We might see some kind of pullback in the weekly and the daily, but I mean the trend is quite clear. If we continue seeing higher lows and higher highs, it just doesn't make sense for you to try to put yourself at a higher risk just trying to short this market only because there's huge potential. Maybe this will never happen again. That doesn't mean that I advocate for just buying indefinitely. I want healthy pullbacks to be met by demand. That's all I'm trying to say because there's still potential for correction, but also potential for going higher. And we have clear structures down here that provide you with strong evidence that buyers, big buyers, are still betting higher. So if you want to really be successful, sometimes you have to really trade the price action and trade the charts because markets sometimes are irrational. And fundamentally, even though we have some flaws and we have some weakness, I mean, you have to really trade the price action that you are seeing. And I think that's my best advice, to really be patient, be disciplined, and manage your risk very, very good because I still think that markets need to pull back. I'm not going to buy up here. I will wait for my opportunity to really look for really good risk reward ratios for longs and not just put myself into pressure trying to short this train. And I think that's all. VIX. VIX is almost at levels of before pandemic, February 2020. This doesn't mean that market is going to flash because look at prior the pandemic, we were at 11, 12 down here, and then this big event, Black Swan event, happened. So for the people that think that big is showing that something huge is happening, I don't trust that. As long as BIX is not seeing huge spikes, I'm confident that the bull runs might happen again. If we see a big spike, then we can reaccommodate and reassess the situation. But right now, having bigs down here and having no kind of, if we check the 15 minute, this is the VIX 1 day, look at this huge volatility, but then it's not progression. It tried to put some pressure, but VIX is telling you that this market, it's super, not greed, but I would say it's quite strong looking for longs. And one last thing, RSP, I would like to review the breadth improved on the market. RSP, remember, is the S&P 500 equal weighted ETF. This is the 1-day chart. We are pushing towards, we broke out this range, but the S&P, the regular one, is just breaking out this pivot. So we should be in the equal weighted above this pivot. We are lagging behind, so that shows you that only a small amount of stocks in the S&P 500 are really outperforming the rest. Breadth is improving, the rest of the stocks are pushing higher, and we broke, in terms of percentage of stocks that are above the 200-day moving average, we broke 50%, sorry. The 48 was here, this was 50, so let me just mark that. So this is 50, this is quite good, but look at these red candles. I mean, I think we are seeing some rotation out of Nasdaq, out of tech stocks, to some other stocks in the overall market, in the Russell and in the S&P 500, that provides you better risk-reward ratios than tech is right now providing to you. So we are seeing some people that is rotating to those undervalued stocks, to just trying to find swings or investments that are better value than these huge overextended tech stocks. This would make sense, but I need to see progression. We don't want to just see this, because that would mean, again, risk off. If we continue to hold this 50 and we see breadth improving, the rest of the stocks getting love, Nasdaq and overall over market pulling back a bit to make and build consolidation above the higher low, dollar continues seeing weakness, gold pushing higher, and we see big staying low and small caps pushing higher, that would still show you risk on appetite is still there, and you can still looking for longs, despite the fact that fundamentally we need some more evidence of inflation progressing going down. But at some point you have to really assess all these markets and to take your own conclusions, to really make your case and build your plans and setups to trade either swing or day trade these markets. Right now, the bullish case is quite strong, even though we are quite extended. We started seeing some pullback, but this is not the end of the world. I think we can continue going higher, but we need to do that in a healthy manner and just wait for those setups, because if they happen, I mean, those will be very, very good, continue the trend, and it would make your day trading more easier than if you're trying to stop this trend, trying to short all those pops. So that's my conclusion. That's my review of the week and the review of the current situation. Let me know in the comments below if you like this kind of setups, this kind of summaries for the week. Hope you have an amazing weekend, long weekend. Remember that on Monday, stock market is closed. Future markets is open with reduced amount of hours. I won't be trading that because there's a huge lack of volume and I don't want to get chopped out. So I'm going to see you again on Tuesday, and I will take some vacations next week, but on Tuesday I will be here for you, getting your information as always. So remember to click the subscribe button if you would like to see more things like this, and let me know in the comments below if you like these weekly summaries, because I'm more than willing to help you in this market, and I would like to do this kind of stuff it's helpful for you. So let me know in the comment below, give it a like. Thank you for the support to the channel, and have a nice long weekend, and see you on Tuesday. Stay safe, everyone.